It's your money. This is CN8 Money Matters Today. And now host Mary Caracoli.
Welcome to CN8 Money Matters. Today, real estate basics. The real estate boom has made owning a home more expensive in many markets around the country. For investors, the double-digit returns are getting a little harder to find. As the market changes, buyers and sellers need to be smarter about how they conduct their business. We want to help you with that. And getting us started, Kenneth Fleischer, a real estate attorney and chair of the real property section of the Philadelphia Bar Association. Also with me, Vincent Ingui. He is the CEO of Levere's Mortgage Corporation, and welcome to you both. The idea of finding a house that is affordable within your means, because, of course, as Ken said, that a lot of folks, most folks do finance their homes, and that means a mortgage. So let's take folks through the process of determining how much house you can afford.
Okay. Before all that happens, what we always say is it's mortgage first. The client needs to come to us. I mean, generally what a buyer will do is we'll go to a mortgage company. What mortgage company obviously comes into whether or not they've been referred by a friend. A realtor sometimes makes that referral. And it's important to get pre-qualified before you start looking at the home that you're looking for. For example, many buyers will actually go out and start looking at different neighborhoods with a house that they like or a place that they like to live without knowing exactly what they're qualified for. So what a mortgage company or a mortgage lender will do is they'll get information regarding the credit, get information regarding assets and employment history, and most importantly, find out what that buyer's goals are. How long are they going to live in the home? You know, what is their monthly budget? And then take care of a mortgage program that revolves around that budget. I think the key thing to that is finding out what the buyer's goals are, because a lender will tell you what maximum you qualify for, not necessarily what's the right loan for you.
Yeah, and that's the important information. And things have changed a little bit over the years. It used to be a little bit more conservative about how much home people felt comfortable affording. And the rule of thumb used to be about 25% of your income. That's changed, hasn't it?
It's changed dramatically. Some lenders actually are lending up to 50 to 55% of your debt-to-income ratio, which can be debatable as far as, you know, whether or not that should be allowed. But you know, I think a good general rule of thumb is if you're about 35 to 38%, which is within Fannie Mae guidelines, that's a good place to start for being able to afford that property.
And I think unless someone has real experience or financial savvy, don't go above that, because there are other costs involved with owning a home that people don't factor in, other payments and utilities and so forth that go into it. So the affordability thing is something that really, even though maybe the regulations are a little more lax than they used to be, I think the buyer should be aware in that they should not take on too much responsibility.
That's a great point. I think for a first-time home buyer, keeping it conservative is probably a good idea. As you become a savvy homeowner or a real estate investor, using that mortgage for leverage and taking advantage of those guidelines that open up or allow you to leverage your credit is a smart decision. But I think that's a good point, is that, you know, a first-time home buyer should probably be more conservative and keep in mind what their lifestyle is. I mean, I know I have clients that make $50,000 a year that have a higher net worth of clients that have to make $100,000 a year, and that doesn't show up on your credit report. So I think it's really important that you sit down with your family before you go seek out the mortgage and find out what is that monthly payment budget, and then find a mortgage that fits that budget.
Good point.